Thank you for standing by, and welcome to the Nine Entertainment Investor Conference Call. All participants are in a listen-only mode. During this call, there will be a presentation followed by a question and answer session for analysts and investors. Media representatives should remain in listen-only mode throughout the call and hold any questions for the separate media briefing that immediately follows this call. Media can contact Nine's Director of Regulatory, Public Affairs and Communications, James Boyce, for more information. If analysts and investors would wish to ask a question after the presentation, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Nine Chief Executive Officer, Matt Stanton. Please go ahead.
Thank you, and good morning everyone, and thank you for joining such short notice. I'm here today with our CFO as well, Martin Roberts. During this briefing, we will work through the presentation we released to the ASX earlier, and I'll guide you through the individual pages as we go. So today is a defining moment for us as we accelerate our Nine 2028 transformation. Our goal is clear: to be Australia's leading digital-first connected media business. We are transitioning away from legacy structures and leaning aggressively into structural growth areas. So I'll kick off on slide 2, which is growth assets to contribute more than 6% of gross revenue, to say we've announced a series of transactions that will accelerate Nine's transition to a growth-focused media company in a way which demonstrates our commitment to enhancing shareholder value. These initiatives reflect Nine's focus on optimising our portfolio of structural growth assets across streaming and broadcast, publishing, marketplaces, and now outdoor. We estimate these growth assets of streaming through Nine Now and Stan, digital publishing, including Drive and outdoor, will contribute more than 60% of our group revenue and around 70% of our group EBITDA going forward. Turning to page 3, which is a summary of the transactions, I'd say we're announcing the acquisition of leading digital outdoor business QMS, coupled with the sale of the Nine Radio business and the restructure of Nine's regional television business in northern New South Wales, in Newcastle, NBN. In total, a net cash of around $600 million is being deployed, which includes around $180 million of cash tax benefits. This will offset much of the capital gains tax previously calculated at $254 million from the sale of Nine's stake in Domain. So let's turn to page 4, and we are buying 100% of QMS Media from Quadrant Private Equity for $850 million. The business does come with around $32 million of cash tax losses, which we intend to offset against the gains from the sale of Domain. Based on forecast EBITDA, inclusive of lease costs of around will be $105 million in CY26, plus an expected $20 million in pro forma cost synergies. This equates to an EBITDA multiple of circa 6.5 times. So now on page 5, QMS, a leading digital player in outdoor. The acquisition of QMS is a high conviction move for us. QMS is a leading player in outdoor media in Australia and New Zealand. They have successfully digitised their premium metro footprint with more than 95% of Australian revenue now digital, well ahead of both its local peers and global comparables, resulting in market share growth from 8% in 2019 to 15% today. As you can see, Out of Home is a standout performer in the Australian market, growing its share of total agency media spend to record levels. Outdoor, as an advertising segment in Australia, has grown strongly over the past 10 years and now attracts an estimated 18% of Australia advertising market revenue. This has been underpinned by the increasing digitisation of key assets, but also as measurement and accountability has improved by the relatively attractive pricing and hence return on investment of the platform. The rollout of Move 2.0 later this calendar year is expected to provide the industry with significantly more granular data across all major formats, including greater geographic coverage, and hour-by-hour breakdown. This is expected to further improve the segment's proposition to agencies and advertisers. We also retain a view supported by industry experts and global peers that outdoor is expected to remain more resilient to the impacts of global platforms and the disruption of AI. So, as we look at page 7, which starts with more than 80% of QMS revenue is sourced, QMS assets are concentrated into metro areas, with more than 80% of the group revenue from Australia and 75% of that sourced from premium Australian assets. QMS has gained significant momentum over the recent years, winning key contracts, most notably the City of Sydney contract for street furniture, the Auckland Transport contract, as well as a number of landmark digital signs around both Melbourne and Sydney. Across the group's Australian portfolio, less than 20% of the group contracts are due for renewal prior to December 2028. On to page 8, creating a unique cross-platform digital media proposition. We find QMS is highly complementary asset to the Nine business. I mentioned cost synergies of circa $20 million previously. This is underpinned by the consolidation of back-office functions and procurement efficiencies. It also includes the continuing opportunity to focus more Nine marketing spend on owned assets, and in the case of outdoor, utilise vacant sites. Across all of Nine, we currently spend around circa $70 million on external marketing, of which more than 20%, mainly Stan, utilises outdoor. It would be reasonable to assume the weighting of this outdoor spend would not migrate to QMS in the future. In addition, Nine's marketing spend could be further augmented by the utilisation of excess inventory, with sell-through rates at the QMS currently around 70 to 80%. Moreover, this creates a unique sofa-to-street advertising ecosystem. By combining QMS with Nine's premium video publishing and data assets, we offer advertisers a cross-platform reach that global platforms cannot replicate. We've had consistent feedback from our advertising partners that they would view such a bundle positively, and our sales teams are confident such an offering will gain traction in the market. There are expected to be similarly important opportunities to amplify Nine's news and sports content, particularly through the increasing important events. We are also excited about the future prospects of our self-service Nine Ad Manager business, with the opportunity to extend both the data applied to and distribution of advertising messaging across the Nine ecosystem. A great example of this could be utilisation of postcode-based marketing both through Nine Now and Outdoor, a potent combination. So, to slide 9, which we move on to radio. As we focus our business on structural growth, we have further announced the sale of Nine Radio to the Laundry Hotel Group at an enterprise value of $56 million, with a tax benefit of around $50 million. We are confident that the Laundry Group will prove a positive outcome for both the radio business and its staff. I've been really impressed with the Laundries during the sale process, and they have been clear about their ambition for the radio business. They see the acquisition as a long-term investment and have immense confidence in the medium. I am pleased that under the ownership of the Laundries, radio will remain a long-term partner of Nine through initiatives including the utilisation of Nine News on radio and Stan through the Laundry venues, promotion and ad sales collaboration for Nine, as well as the expectation of an increased ad spend by the group onto the Nine properties. Nine continues to remain committed to other digital audio opportunities. We retain a strong presence in podcasts and digital streaming via our mastheads and Nine Now. And thirdly, turning to slide 10, broadening of the Nine affiliate agreement to include NBN, we have finalised an agreement which will result in the conversion of NBN, Northern New South Wales, from a business wholly owned by Nine to an affiliate operated by our long-term regional partner, the WIN Network. As WIN is also our major shareholder, this element will also require shareholder approval. We expect the deal to complete in the June quarter. We believe that the WIN is best placed to operate NBN going forward, continuing to access Nine's content and national sales in return for an ongoing affiliate fee of circa 50% of the NBN revenue, consistent with the other WIN properties. In addition, Nine will receive $15 million in cash, with a further cash tax benefit of around $95 million relating to the transaction. Okay, so slide 11 is there to sort of the combined financial impact, summarizes the impact of these three transactions. In total, Nine will outlay around $780 million in cash, before the benefit of around $180 million in cash tax losses, which will offset much of the previously calculated domain tax bill of $254 million. We have already paid the majority of this tax. The benefits associated with these transactions are expected to offset the tax instalments payable over the remainder of FY26 and result in a tax refund in early 2027. On an FY26 pro forma basis, we expect the transactions to result in a combined positive EBITDA impact of circa $80 million pre-AASB basis. In terms of EPS, on an FY26 pro forma basis, including the full run rate synergies in combination, these initiatives are expected to be accretive to earnings per share in the low double-digit percentages. As at the end of June, we would expect the Nine's net leverage ratio will increase to around 1.8 times. However, this will quickly wind back to our stated comfort range of 1 to 1.5 times, with the benefit of the tax losses augmenting Nine's enhanced cash flow post-transaction. We should also point out that by virtue of the special fully franked dividend we paid in September and these subsequent tax offsets, there will be an impact on our franking account position, meaning that we are now expecting our FY26 interim and final dividends, and likely our H1 FY27 dividend, to be unfranked. Notwithstanding, we remain committed to our 60 to 80% payout ratio. So finally, turning to page 12, this marks a significant step change at Nine, and one that we are very excited about. Our goal is clear: to be Australia's leading digital-first connected media business. We are confident that the transactions we have announced will accelerate Nine's transition to a digitally focused, structurally growing media company in a way which demonstrates our commitment to enhancing shareholder value. We are moving from a traditional media-based business to a data-driven, integrated digital media powerhouse. This is the right move for our people, our advertisers, and our shareholders. I'll now turn the call over to Q&A. Operator, do we have our first call?
Thank you. If you wish to ask a question, please press star one on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star two, and if you're on a speakerphone, please pick up the handset to ask your question. This Q&A session is reserved for analysts and investors only. Media representatives should remain on listen-only mode. Your first question comes from Eric Choi from Barrenjoey. Please go ahead.
Oh, hey, morning guys, and congrats on the deal. Sorry, just maybe two from me and a bit off the cuff given short notice, but maybe a numbers question first. You sort of said the transaction is marginally EPS accretive pre-synergies, and it's going to be double-digit EPS accretive post-synergies. And then you've sort of said synergies are 20 million pre-tax, which is kind of 14 million post-tax. But I guess if the difference between no EPS accretion and 10% plus EPS or NPAT accretion is 14 million, you're kind of guiding to an FY26 base NPAT number, which is kind of 140 or less. So I was just wondering if that logic is broadly correct. Should I go with the second question? question, Matt, or let you go with that one?
Look, thanks. Hi, Eric. Let's maybe just take that one. We might take on notice, but I'll just hand over to Martin just quickly. Maybe you can give some light on that.
So I think the fact we haven't, Eric, given you specific numbers is we don't want to give you specific guidance on the NPAT number, so it's directional. But your logic is correct, yes.
Okay, awesome.
And then the second question.
Sorry, away from the numbers, but sorry, got to dust off the outdoor hat now. But and apologies if I've missed it. But have you given any sort of capex guidance? Because I guess I remember many years ago when QMS won the City of Sydney contract, it probably had some pretty sharp terms in terms of capex investment and who owns the assets. Maybe I'm remembering that wrong, but I guess if you could give us a flavour for capex and capex requirements going forward.
Yeah, no, thanks, Eric. Yeah, I mean, what we picked up actually, which we're very pleased, there's a lot of capital being invested in this business already, especially you think about the investment in the City of Sydney, which is, hundreds of millions of dollars. That's actually in the ground now and spent. So we're looking forward on the capex stuff. Martin, I know the run rate going forward.
Yeah, Eric, the capex for QMS is probably going to be about circa 50 million per annum, certainly in the first year or two, and that's slightly below where their depreciation is, which is between 55 and 60 million.
Awesome. I'll give everyone else a go. Congrats again. Thanks.
Thanks, Eric.
Thank you. Your next question comes from Tom Beadle from Jarden. Please go ahead.
Hi, guys. Yeah, congrats on the deal. I've got 3 questions, please. Just the first one on leverage. Just I guess a couple of things around that. Just that FY 27 guide is obviously fairly wide, sorry. I mean, can you just talk to some of the assumptions you're making to get to that outcome? And it's probably fair to say as well that that's probably a bit higher than your comfort range. So do you have any medium-term leverage targets that you can share?
Yeah, sure. We'll take these one at a time then, okay? So, maybe Martin, do you want to answer that one?
Yeah. So Tom, it's Martin. So the way to think about it in terms of leverage, so obviously we go up to 1.8 times because of the domain capital gains tax and obviously the additional cost of the acquisitions, the gross outlay. We'll go through we've paid 200 million of the 254 million capital gains tax in the first half this year. We'll complete that in the second half. And then we'll get circa 160 million of the 178 million as a refund in December or January. Could be one of the two. And then further 18 million will flow through our normal tax returns. And so you can see at the 1.8 times gives you a good indication of what the leverage would be absent those tax benefits. And those tax benefits are about 0.4 turns on the leverage. So it goes up at the end of FY26 and then it'll come down. Clearly, we're guiding you between the 1 and 1.5 times because we don't want to give you any kind of guidance on our FY27 base EBITDA. I think you probably appreciate that's appropriate.
Yeah, completely understand that. No, thank you. That's helpful. Just a second question. Just QMS has obviously got that small New Zealand business. I mean, do you see this as core or might you look to sell that at some stage?
Yeah, thanks. Look, it's a business they've just acquired through and just grown. So great business. It's growing really rapidly and working well. So yeah, no, it's a part of the group got through. Obviously, we haven't actually completed yet on this. So it's a good part of the business. Albeit you're right, it's in New Zealand, but there's no plans to change that at this point.
Great. And just a final question. Just does the sale of the radio business include any formal partnership with the Laundry Group just to spend across 9 properties and to use your talent? And if so, just how long do these agreements go for? And is it just possible to give us a feel for the materiality of them? Yeah,
no, I wouldn't say it was super material. It's not, but it is a strategic partnership that we've agreed to. Is it formalised in a document signed and sealed? No. Is it written down? Yes. It's probably it's at least 3 years, and I think both parties feel like it will endure way past that. Very strong relationship we've developed with Craig and the team there. So I think it's complementary, right? So for us, the opportunity to work with them if we need to around any ad sales collaboration, whether we are in market with, and radio is key to a proposal and vice versa on the radio side. The laundry group, very impressive hotel group, active conversations around Stan being implemented into those areas. We've got to work through some of the technical details on that. And there is an agreement for them to spend marketing money on our assets. So you can imagine, some of the spend at the moment. We've got 9 now is a digital business that's down to postcode that we can basically promote for them. They see that as very attractive. There's a number of contracts that we've got to sort out post this. And so it's a good relationship. We haven't put a lot of money to it, obviously, so I don't want to call it out as material, but I think it's a great step going forward.
Great. Thank you.
Okay, thanks, mate.
Thank you. Your next question comes from Entcho Raykovski from E&P. Please go ahead.
Morning. My first question is just around QMS and the revenue estimate of 400 million that's put in the presentation for calendar year 26. I wonder if you're able to give us a little bit more color around your assumptions, whether you're expecting this to be driven by the out-of-home market, continued market share gains, and I suppose what's your level of visibility given it's very much a cyclical market or a cyclical sector as well. So presumably there's a level of variability around that number. I'll run another couple, but maybe we'll stick to that one first.
Sure. Yeah. It was a bit hard to hear everything you just asked there, if I'm honest. So I think you said you asked around the revenue growth, what we're expecting and how they're achieving that. Is that right?
Yeah, correct. I think you've put in. Sorry, hopefully you can hear me better now. I think you've put in a number of 400 million expected for calendar year 26 for QMS, and so question of what you think will be the driver, whether it's the out-of-home market or further share gains and level of visibility.
Yeah, okay. So look, I think probably where we see it, there's 3 main drivers to that. We believe that the market will continue to grow on outdoors. That's the first driver. I think the outdoor market is in good growth and continue to be very resilient in some of these tough trading areas. So we see continued growth there. We see that QMS will continue to take market share. So there'll be a share area as well for the nature of the digital assets that they've got. And thirdly, we think that we know that the new contracts that they've got in place that they've won are actually coming up to speed now. So that'll be from contract wins as well. So it's threefold is the revenue that we've worked through.
And sorry, Matt, to press you specifically on this, are you able to quantify the new contract contribution?
No, we can't do that we can't do that at this point. We're not ready to disclose that.
Okay, cool. And as part of this process, did Quadrant run a competitive sale process for QMS? I'm assuming they would have considered plenty of options for monetisation. And I suppose and part of the reason why I ask is often people will view purchases of assets from private equity as fairly sceptically. Do you have any concern that as you're buying from a sponsor, this may well require increased spend down the track? You've obviously given the synergy targets, but is there, I guess you would have done sufficient due diligence and any, I suppose, areas of concern around the asset?
First of all, we don't have any issues or worries. We've done a hell of a lot of due diligence as we've gone through this process. So and through the contracts and so forth. So this is not something we've done. This has happened over some period of time. I think have they gone through a process through there? We were working with them over a period of time, getting to know them, and I think that they may have had other opportunities to talk to people, but we've just been working at our pace on it in a very good way with Quadrant, and we're very pleased with the process we went through and the value that we've got. So look, we understand. I understand your question. We've done a lot of work on this and done a lot of due diligence through this. And so we've had time and space to get ourselves comfortable with this transaction. And we've looked at, other assets in this marketplace. This is something that we've been working through. We like the categories. We've worked through all the different assets that are there. And QMS is one that we really like because, it's very digitally focused. The contracts are, pretty set down now for the next 3 or 4 years. And therefore we can look forward to investment and growth versus in an offensive way rather than defending contracts. And it fits with our business well. So, this is something, a very considered transaction that we've just done here. This is not something we off the cuff trying to do. This has been a year of work through.
And then, Joe, it's Martin. I'll just add to everything that Matt's just said is that obviously because we're not in outdoor advertising, in addition to our normal advisors we've had that you'd expect, financial, investment banking, etc., we've had a team of industry experts in the outdoor area help us with the commercial due diligence as well. So we've had some incredibly good insights from them in terms of expert opinion on the outdoor advertising market in Australia. And also obviously we know the advertising agencies really well. So we talk to a lot of them about these businesses and making sure that we're comfortable with them. So very comfortable with the process we went through.
Okay, great. Just a very final one from me. Have you identified specific contracts that QMS could bid for? What are the sort of near-term opportunities for contract wins, given that their contract pipeline is basically set for the next few years?
Yeah, no, I mean, they've just won a number of contracts. There are a number of contracts that will come up, and we'll be active in the process on those contracts going forward. I mean, I think that's, where we'll be. I don't want to call out individual contracts at this point.
Okay, no worries. Thanks, Matt. Thanks, Martin.
Thank you.
Thank you. Once again, if analysts and investors would like to ask a question, please press star one. Your next question comes from Brian Han from Morningstar. Please go ahead.
Matt, you said somewhere that there's additional potential from bundling with QMS. Now, putting aside the fact that we've heard this bundling myth for some time now, but have you thought of any dyssynergies which may occur with this acquisition?
Look, we haven't factored in the revenue synergies in the financial point of view in our numbers here, but we do believe in there's some good revenue synergies going through. In the same way, we haven't done our dyssynergies. We don't see any material dyssynergies at all from this. We think the reality is in the ad market. Scale is really important there. Dealing with the big 4 or 5 agencies is crucial of having a voice, and this is very strong. So, don't forget, radio comes out, so that does come out in this here where we do, and this comes in, which is a high growth asset that we're getting, and it's very agency focused. So we feel, there isn't any material dyssynergies that we see coming through, Brian.
Great. Thanks, Matt. And just to clarify what you said before, you said Nine spends in total $70 million on external marketing spend. Can I just confirm, did you say $20 million of that is on outdoor? Is that what you said?
20%, I think I said, was on outdoor. So I think
20%.
we can get. Yeah, so we can come back to you on that, but about that. So now, as you can imagine, right? So we spend on the marketing money. Because the sell-through rate on outdoor will be circa 70 to 80%. There is a lot of inventory that we can utilise to drive promotion for the likes of Stan, the likes of the AFR, the likes of SMH and the Age. That's not even factored into this. So it's a huge upside. We think not just the swapping out of ad inventory from different competitors into ours. It's really around that opportunity to grow the other stuff. So we feel pretty good about that, about going forward.
Thank you, Matt.
Thank you.
Next question. Sorry.
Your next question comes from Mike Younger from Prime Value. Please go ahead.
Thank you. Just on QMS key management, can you tell us which key management are coming over and which are not?
Yeah, look, we haven't had good, long conversations, obviously, because we haven't completed yet, and they're just announcing today. But we've had some very good interactions with the team there as we gone through this process. So John O'Neill, who's the CEO, will report directly into myself. We'll keep it as a division at this point in time. We've been very impressed with the team of where they're at, the drive, energy, and their strategy. You know, there'll be, we expect the majority of the team to come across.
Great. Thank you.
Thank you. Your next question comes from Fraser McLeish from MST Marquee. Please go ahead.
Yeah. Hi, Martin. So most of my questions have been asked, but just a quick one, just to clarify. Those savings you were talking about on shifting marketing spend, in terms of the 20% of the 70 million that's spent on outdoor, that's not included in your 20 million of synergy?
Yeah, no. Yeah, Fraser, it is. So the 20 million dollars is made up of, you know, it's probably three or four things. Firstly, obviously some back office synergies, and some procurement savings. And so that's sort of circa half of it, and the other half of it pretty much is the marketing benefit that we get from doing this.
Yeah. Okay. All right. Thanks. That's helpful. Cheers.
Okay. Thanks, Fraser.
Thank you. Your next question comes from Ailsa Lee from UBS. Please go ahead.
Morning. Thanks, Martin. Thanks, Matt. I just have two quick questions, and sorry I dropped out before. But firstly, if I could just double-check, you've got about 20% of contracts at QMS expiring earlier than 2028. Just wondering when they start to come up for renewal.
Well, look, there's a number of different contracts. There's multiple contracts, and they'll come up over the period of the next 3 or 4 years. So you know, the material ones are locked down for a long period of time. So that's the main point here. And then there's lots of smaller contracts that will churn, and we would expect to obviously win those contracts, but those will take over the next 4 years. So there's nothing material that comes out in the next 4 years.
Yep, understood. Thank you. And then my second question, maybe with Nine's digital revenue expected to be 60% of revenue going forward, how are you thinking about the balance between ongoing investment required back into legacy free-to-air and digital assets?
Yeah, look, it's a good question, because don't forget, and when we say, you know, free-to-air, legacy assets, you know, we think about total TV, so Nine now and free-to-air together. The content, you know, is the same that's on Nine now as it is on free-to-air. So if we're doing mass, right, the mass cost is basically, you know, split between free-to-air. So if we didn't have free-to-air, we'd have digital, so you have to still pay it. So the investment we will do is into content, the right content across our platforms, and then, you know, in the ways that people want to see it. So we still have, you know, huge numbers, obviously, which are growing on our broadcast business, but on the digital side as well. So, you know, we obviously invest in the tech and products and tech for Nine now and some of the digital assets, but the content is shared across all the platforms. So that's how we think about it. We try and obviously be as efficient as we can on some of the, you know, broadcast areas of the business, and invest as much as we can into the content side. With the digital side, you have to sort of invest a little bit in the products and tech as well as the content side.
Great.
Okay.
Thank you.
Thanks.
Thank you. That does complete our analyst and investor Q&A session. Analysts and investors may now disconnect. We would now like to invite media representatives to ask their questions. If you do wish to ask a question, you may press star then one on your telephone and wait for your name to be announced. We'll pause a moment to assemble our roster. Once again, if media would like to ask a question, please press star one.
I've had a lot of people.
Okay. I'm not sure I think we've had a lot of questions coming in through separate routes directly. So if there's nobody else on the line, we can shut it down.
Thank you. There are no further questions.
Great.
I'd now like to hand back for closing remarks.
Okay. Well, thank you. Look, I'm not sure if anybody is on the line. If you're on the line, we are supercharging Nine's transformation through this and accelerating the transition to a structural growth business. These series of transactions represent the biggest change to Nine's portfolio back since the acquisition of Fairfax, actually in 2018. We're reshaping the business and diversifying the group's revenue streams. With a focus on scale, diversification of revenue streams, flexibility for advertising agencies, and opportunities through growth synergies and the potential QMS brings to us. The decision on a high-growth outdoor media platform leads us to this 60% of revenue coming through growth assets, creating a powerful advertising proposition for Nine Group that extends across the Australian community from the sofa to the street. We will have greater flexibility in how we work with advertisers and agencies. Thank you for your time today, and I look forward to catching up with you soon.
That does conclude our conference for today. Thank you for participating. You may now disconnect.